This episode of the Old Dogs REI Network is brought to you by Mino Studio.
In a world where jobs are how most people make money, one man, one desire, one challenge dares to break the mold. Welcome to the Old Dogs REI Network, where we don't work for money. Money works for us. Coming soon. Viewer discretion advised.
Welcome to the Old Dogs REI Network, where cash flow is king. Real estate investing, the means, so you can enjoy your retirement dreams. This is the show where we cut right to the chase. No sales pitch, no long monologues, just simple how-to real estate investing advice, so you can earn the passive income you need to enjoy your retirement today. And now, your host and chief old dog, Bill Manacero.
Welcome to the Old Dogs REI Network. I'm your host, Bill Manacero, and this is the show where 50-plussers and anyone else who wants to join us get solid, no sales pitch real estate investing advice to help generate real cash flow. This podcast airs twice weekly on Mondays and Fridays, and if you aren't already a subscriber, go to iTunes or Apple Podcast, type in Old Dogs, spelled D-A-W-G-S, find our podcast, and subscribe. Well, we have a great show for you today. We have a gentleman who has a lot of experience in real estate investing. I'm talking about Chris Larson. Now, Chris is the founder and managing partner of Net Level Income. He has been investing in and managing real estate for over 20 years. While still a college student, he bought his first rental property at age 21. From there, Chris expanded into development, private lending, buying distressed debt, as well as commercial offices, and ultimately syndicating multifamily properties. He began syndicating deals in 2016, has raised more than $15 million, and been actively involved in over $150 million of real estate acquisitions. Chris is also very passionate about helping other investors become financially independent. Well, Chris, welcome to the Old Dogs REI Network.
Bill, thanks for having me on today. I'm excited to be here.
Well, it is my pleasure, and just dying to hear your story, how you got into real estate investing. I mean, the bio kind of says you bought your first property at 21, then all of a sudden you're you're into development, private lending. There must be some things between there that kind of brought you up to the next level. But let me hear, maybe not. Why don't you just kind of give us your background? Whereabouts are you located?
So I currently live in Asheville, North Carolina. We've been here for about 13 years. We moved, my wife and I, from the D.C. area before that.
Oh, that's beautiful country out there. Oh, man, that's awesome. Well, great. Well, tell me your story.
Yeah, so, I mean, you kind of mentioned some of it here, Bill. So I started off at 21. And by the way, if you're listening today and I kind of blow through this and you want to learn more, I have all this in my book, which you can get at nextlevelincome.com. You can click on the book link. We actually just launched yesterday the audiobook as well. So if you're like me and you prefer to listen, you can get it there. But I started at age 21 as an investor. Before that, I wanted to be a professional cyclist. So I grew up in Maryland. I raced my bike from the age of 14 on, and I spent almost every day after school, my summers, traveling, racing, riding my bike. I went to Virginia Tech, where I studied biomechanical engineering, but I didn't want to be an engineer. I knew that 2 weeks in, I just wanted to race my bike. So I figured I'd get a degree, I'd train, I'd go become a professional, and then I'd, come back to school, maybe get a master's degree and figure out what I really wanted to do. Well, as life often does, it threw a wrench in the works. And between my freshman and sophomore years, my best friend, my training partner, who was like a brother to me, and my roommate Chris passed away of a massive brain hemorrhage. And I spent another year racing, Bill. But what I realized at the end of that year was that I won Chris's memorial race for the second time a year after he passed away. And I wasn't happy. I was successful on the bike. Actually wasn't really doing that well in school, but I just wasn't happy, even though I was achieving all the success and what I thought would make me happy. So I went back to school. I quit racing my bike, and I thought, like, what am I going to do? I kind of just ended up being a college student. But what I learned while I was riding, I was racing, was that I loved freedom. I love the sense of freedom that cycling gave you. I'll never forget the first time I left the neighborhood on my bike, and it was just like this amazing ability to be independent. And then I still had this desire for freedom in life, but now it was driven by the desire to live life on my own terms and live the best life I could, not only to honor the life that I was given, but also honor the life that Chris didn't have anymore. So to do that, I decided I was going to be an investor. I had a family friend that had given me a book, Money Magazine. It talked about Roth IRAs and compound interest. And I thought, I can start investing in the stock market and I can be financially independent at a pretty young age. So I did that. I actually started day trading about a year after that, and I was doing quite well. But the stress laying there at 3 a.m. in the morning really got to me. And I thought, well, do I really want to be doing this 20 years from now? And now I'm about 20 years from then, 21 years from that point. And what I decided at that time was to look into other options. And I bought my first piece of real estate at 21. I like the fact that you could leverage, you could buy with a small amount of money, you could have control over the purchase, and there was a lot of tax benefits that you could utilize with real estate. I built a portfolio, and long story short, went from that one unit to over 1,500 units today. And what we currently focus on, Bill, is mostly commercial multifamily real estate.
And the first property, I assume, is a single family home?
Yeah, I kind of blew by that. It was just a little single family, actually attached townhouse in Blacksburg, Virginia, where I went to school.
Interesting. And how did you end up leveraging that? I mean, did it build up an equity pretty quickly, or what was sort of the tool that got you to be able to expand your portfolio?
Yeah, so my original strategy was built from a book that was called Buy and Hold. And this investor talked about buying property, just being patient, letting them pay their mortgages off. And at some point you were going to be financially independent because you're going to have these paid off properties. So my plan was to buy enough properties to have $10,000 a month coming in after expenses and pay those properties off over the course of 15 years. So I said, okay, I got to buy enough properties, which I did by the time I was 25. And I have to find a way to make enough money to pay these off on a rapid time schedule. I did that as well. But what I found along the way after doing that for, it was about 10 or 12 years, I figured out there was a better way. And that was by pulling that money out of those properties and actually leveraging into commercial properties. So my original plan was just to buy those properties. As I made money, pay them off. And then ultimately I leveraged the equity in those properties, Bill, into the portfolio that we have today.
Now, were you working a full-time job when you first started investing?
Yeah, so I started off actually with two jobs. I was working for State Farm. I also had my real estate license, and I was finishing my MBA. And then I ended up going into the medical device industry. I spent 18 years, if you count the 2 years I spent with Pfizer, which is technically a pharmaceutical, the pharmaceutical industry. And March of this year, 2021, marked my last day, my last month in that industry, it's hard to leave when you spend 18 years doing something. But yeah, the whole time I was building the portfolio, I was working full time.
Wow. So you're talking real recent here that you quit that full-time job, right?
Yeah, like I said, Bill, it's been something that's been kind of in the back of my mind in the works for really 5 years. But I went from being a full-time sales rep, and for anyone that's listening that's not familiar with the medical device profession, there are certain segments of it where you are on call. So really, you're a slave to the surgery schedule. You're just waiting until that surgery is posted. And I was doing, sometimes 20 cases a week, and then I was on call. And sometimes I'd spend the night in the hospital when I was working as a rep. I went from being a rep about 5 years ago to a management role. That gave me a little bit more control over my time. And it really gave me a second wind. I really enjoyed the ability to to find talent, to train talent, and ultimately, grow a business with the team that I had. So I think if I stuck with being just a rep, I would have burned out probably 4 years ago. But I feel very fortunate to have been in a leadership role and enjoy a little bit longer career than I would have otherwise.
And with your investments, were you managing those by yourself during this time while you were still working full time?
Yeah, great question. So mostly yes. So the single family portfolio, I managed almost entirely myself. I either had local teams that could help me with respect to renting them or doing repairs. With the commercial properties, we have some smaller commercial properties that my wife and I manage ourselves, as well as Airbnb, short-term rental. But for the large apartments, we have operating partners, and that's really kind of a key. So if you're listening, trying to figure out what your niche is, if you're looking at real estate, you have to figure out how active you want to be. If you're a professional, if you're making $300,000, $400,000, $500,000 a year, like a lot of the doctors, specialists, surgeons that invest with us, your time might be better spent in the OR and letting somebody else do that. Whereas, some people that are listening say, hey, I really want to be active and actually manage those myself. So it was a blend. It was kind of a hybrid depending on the property, the type, and the location.
When did you do your first syndication?
We syndicated our first deal. We closed on it August of 2016. So coming up on 5 years ago now.
Wow. How did you get into that? I mean, that's a pretty big move from, operating, single family homes to going into syndication.
Yes, and it's done very intentionally. First off, so my former partner and I, we started off as passive investors. So I started off as a passive investor. Actually, introduced him to the same group that I invested with. We ended up working with that group as a partner on our first acquisition. So we started investing, I want to say in 2013, and then about 2 years later, made the decision to actually scale and go after a property ourselves, leverage that management. And then we, less than a year later, we closed on our first acquisition. It was a 100-door property, a $9 million acquisition in the Atlanta market.
Wow. Well, that was that's definitely a big leap. I would imagine. How many doors did you have at that time in your other properties?
Yeah, so I actually started to sell off my single family portfolio. So by the time we closed on that first syndication, I had sold my entire single family portfolio. I'm trying to think here, I have to go back. We were doing development. So my wife and I typically had at least one single family development project that we were working on. And then we have 7 units in downtown Asheville as well. That's a commercial office space.
Wow. Okay, so you already started to diversify somewhat there, and also going into development is a big step too. How did you get involved there? Were you passive in that, or were you pretty much involved from ground up?
Yeah, so we were doing fairly small deals, Bill. So here in Asheville, we were buying lots for somewhere between $40,000 and $80,000, and this is going back to about 2012. So I was sourcing the lots with my realtor. I was buying those lots with cash. My wife's an architect, so she would design the properties. Our building partner would build those properties, those spec homes, and then we'd sell them out the backside. So it was a pretty turnkey operation that we did for about 5 years, and it was a nice way for actually my wife at the time. We were looking for a way for her to make some more money because she was working part-time as an architect. And what I can tell you is the first year she went back to work, quote unquote, full-time, which was part-time as a mother with our 2 boys in daycare. It actually cost us $11,000 after tax for her to work after we paid for our daycare expense.
Gee.
Yeah. So after some brainstorming and going to some business meetings, we decided that doing single family development at the time, that's a time when 1 out of 40 banks in the area would actually lend on a spec house. So it was a very hard time to get cash, to get money to build. But we started around that time. And I mean, obviously we're kind of coming into a boom market right now, where a lot of people are, we just can't build fast enough. Building costs have increased. So we've kind of cycled out of that to a degree. But yeah, it was a good business for us to be in for about 5 years.
And they were just sort of typical, 3-2 type single family homes, or?
Yeah. So what we did, I did a market assessment, and I went after the area of the market that had the biggest differential between build costs and sales costs. And what I found was, typically you kind of hit the nail on the head: 3.2, 3.3, 4.3, somewhere in that range. About $400,000 plus or minus sales price in Asheville that were green built. And my wife is a LEED certified architect, or I'm sorry, LEED accredited. She would tap me on my shoulder and correct me if she was here in the office next to me, but LEED accredited architect. So that was a market that actually had a premium on per square foot sales price. And that was the market that we focused on.
Interesting. And was it, did you from the beginning end up getting pretty good profit off of each property?
Yeah, we did quite well for each one that we did. We kind of backed out of that when we saw the after-tax returns from our multifamily deals come close to what we were getting from those development deals, which were obviously, quite active. And they call them spec houses for a reason, because they are speculative investments. And, you have to typically, hold, between the hold period, the turn time, you're looking at maybe 12 to 18 months full cycle per deal. So, we did very well, but as kind of the risk increased and the profit decreased, we backed away from that. We actually also built our own primary residence here in Asheville. We have an Airbnb in it, and we have a guest house on the property as well that we use, kind of a midterm corporate rental. So that was our project that we rolled into after doing those spec homes.
Fun. Wow. And then you got into the commercial side. Can you talk a little bit about the offices that you also got involved with?
Yeah, so that occupies kind of a minority of the options that we do out there, but we do some commercial office as well. There's definitely a lot of speculation around where that's going to go in the future after 2020 and the COVID pandemic. But I think we're at an interesting time where there's some really good deals out there in the office space, and if you're selective of where you buy, I think that if you talk to business owners, if you talk to people, they want to go back to work. They want to see each other. They want to work in an office environment, maybe have some additional flexibility, but they want to go back and have that collaborative workspace.
Is now on these types of properties, is it more in a suburb environment, or are they large buildings? What kind of office suites or buildings you were involved with?
Yeah, so the markets that we target on the office side, Bill, are typically suburban, kind of secondary or tertiary markets like Kansas City, some other markets in the Midwest. One of our latest acquisitions was in Jacksonville. The current portfolio that we're targeting is in kind of the upper Midwest. So, we're looking at markets that are growing, that might not be, those primary markets that people think about when they think about office, but they have high quality of life, they have low costs, and we're typically going in and getting these properties at a fairly low basis, sometimes like 20 cents on the dollar from build costs. So these are being bought at really good prices based upon what they were either built at or what the market's going for.
And how did you respond to the COVID in terms of your office properties?
Yeah, it's interesting. I mean, I'll take the 7-unit property we have here in Asheville. So we had one out of 7 of the tenants that we have could not pay their rent, and they had to actually close their business down, which is really sad to see, and that's a whole nother discussion. But we had 2 other tenants in there that actually expanded during that time. So one of the tenants, their business expanded. They actually do tattoos, which has continued to be a thriving business during this time. It's a market I know almost nothing about, but it always amazes me how people make money and what businesses do well in different times. And that seems to be one of those businesses. And then the other tenant in there, they expanded as well as they had more people come on board. They're a real estate company, do a little bit different than what we do, but they've expanded. They have more agents on board, so they wanted more space so that they could meet with clients kind of in a safe setting. So again, that's just a very simple example of how you take 5 or so tenants in a space and how you have different responses to the pandemic. So some of the other things that we did, we implemented procedures to make sure that people were wearing masks on the premises. They were either waiting in their cars if they had appointments that were there, or that they weren't kind of loitering in the common spaces. during that period.
In 2020, I think most of us did a lot of self-reflection. For many, it was around personal growth, maybe career choices, personal finances, you name it. One topic that really surfaced post-2020 is giving back. How can we make a difference in someone else's life? And is it possible to do good for others while actually making money? I'm really glad to share with you that our new partner, Equity and Help, literally, it helps you do exactly that. Equity and Help grows your capital while helping others and shows how the simple act of investing can make a huge difference to American families. In addition to their 8 to 12% average return, which is a reward in itself, Equity and Help makes it possible to help a family in need. The mission of Equity and Help is to give families the realization of the American dream, to own a home of their own when they might otherwise have not been able to. They have already helped almost 400 families find their home. If you are interested in a philanthropic investment model with an average return of 8 to 12%, according to Equity and Help, and helping American families, you can speak to a so-called philanthro investor at Equity and Help. Just visit equityandhelp.com/podcast. Again, that's equityandhelp.com/podcast. It sounded like you fared well, at least at that one property. And I think that in some regards, that's an area, especially if they're smaller office buildings, they seem to be doing better than the major downtown type buildings, the skyscrapers that have been hit pretty hard, from my understanding, that a lot of those companies have actually sort of spread, if they have continued to exist. Some have moved into the suburban markets where people want to be closer to their homes and still have an opportunity for meetings. Sometimes the meetings are just once a week, for the marketing department or what have you, but they still have, an office presence.
Yeah, it's really, what I found, Bill, is it's really market by market. So, if you're talking about San Francisco or New York, they've been hit really, really hard. Some of these other suburban areas are actually growing because companies are relocating, and when they're going and they're taking over office space, they want more space because they don't have these co-working kind of environments where people are sitting on top of each other. So they have more space when they're going in there. So it really depends. You have to be selective as you look at who the tenants are. And that's no different than the multifamily space. A year ago, we were in the middle of an acquisition in March of 2020 as all this happened. And one of the things that we did during that period is we did a resident by resident analysis of who was at risk of potentially losing their job. And what we saw was about 2% of our residents in that specific property had service or high risk jobs. And what happened was we saw that collections were actually 98%. They were perfectly correlated with the risk of the job. So these white collar markets that are in suburbs like this one that we were buying was outside of kind of the two markets we focus on, North Carolina, Raleigh and Charlotte, and those markets both fared very similar. So these higher income, white collar areas, collections remained very stable and did really well, even though the pandemic, caused a lot of havoc in commercial real estate. Those markets were very stable and those properties were very stable.
Interesting. Wow. Well, you've been doing this for a little while here. I mean, and I know
a little while.
Yeah, more recently in the syndication side. Yeah, but what kind of one of the things we like to do is ask questions that that will help others to sort of learn and avoid mistakes and things that you might have encountered. And so I was going to say, what was one of the biggest mistakes that you did do that you learned from, and hopefully it helped you to reflect and move ahead, that much more dynamically?
Yeah, I think when it comes to the commercial space, there's a couple things. Like the team is so important. I talk about my book. As I mentioned earlier, you can get it at our website, nextlevelincome.com, at the book link. I'm actually giving it away to listeners today. But I talk about how real estate is a team sport. And this goes from partners as well as any of your operating partners. So what I mean is you can have partnerships that don't go bad because views aren't aligned, visions aren't aligned. And then also you can have properties that underperform due to say, poor property management, for instance. So one of our earlier investments as a passive investor was in the Houston market. And this property it started off doing really well. And then the property managers lagged a little bit. They had to be replaced. I think we went through 2 different property managers at that property. But in the midst of that, what happened was there was a downturn in the market due to oil prices. This was about 5 years ago, and oil prices crashed. And then the hurricane came through Houston. It blew part of the roof off of that building. So what happened was, I talk now about the risks associated and what you learn. So you have to assess kind of 3 areas, Bill, when you're looking at a commercial syndication, a multifamily syndication. One is the market. Are you comfortable with the market? Are you comfortable with the risks in the market? Houston seemed to be a strong market. They've actually diversified even more now, but they were still hit really hard by those prices. So every property in that area got affected to a degree. Number 2 is the team. Was the team right? The team in that property didn't do a great job. We had to swap out the property management team, and that caused some issues. And then you also talk about, deal level performance. And at that property, it was hit really hard by some over leveraging as well. So, you have to learn about those 3 different areas: geographic, the team that you're working with, as well as the deal level risks and deal level performance. And that's an example of everything not being ideal in a property. So what I've learned now is, sometimes you want to diversify across geographic markets, so your whole portfolio is not hit if you're in something like that, or you at least want to assess and minimize the risks in that. You want to be comfortable with your team. You want to make sure it's robust in all types of situations. And then, again, talking about diversification, you might not want to put all your eggs in one basket when it comes to different properties, depending on what your investment strategy is.
Sure. And that was what size building was that? It was an apartment, right?
Yeah, it was about 200 units. Yep, it was a mid 80s built about 200 unit apartment building. So kind of like a bread and butter deal.
And how did it fare after that?
Yeah, so we ended up selling that property. The general partner sold that property, and interestingly enough, we still made money. So that was probably the worst multifamily deal I've ever been a part of, and we still made money on the deal. So that's kind of an attestation of the stability of these multifamily deals that we go into. I'm not saying you can't lose money, but it's fairly robust when all those things can go wrong and you can still preserve your capital and even make a little bit of money on it.
That's great. What would you say was one of your bigger successes that you learned from?
Yeah, I would say kind of the lesson I learned is stay in your lane, right? So I've experimented with a bunch of different investments. If anybody looks at kind of my bio and sees what I've looked at over the last 20 years, everything from day trading to oil and gas to different private lending. But interestingly enough, the most successful deals that I've done have been the smaller deals that I've directly managed. And I think what happens is, when a market intimately, so like Asheville, for instance, I've been studying this market for 13 years. And as I follow the trends around town, you can figure out kind of where the next big booming sectors are going to be. And I actually wrote an article in my podcast. I think the title was talking about geographic arbitrage. But actually that little 7-unit deal in downtown Asheville, we bought from the bank. We bought in an area that was kind of up and coming. It wasn't sexy at the time, but now it's one of the booming areas of Asheville. And it took adequate reserves. We had to pump some money into it on the front end. We had to really apply everything that we knew in terms of renting it, getting that rented, getting the tenants that were in there happy, making sure that they were happy, and then getting markets up to market levels. But then what we saw appreciation from the income increase. And that is one interesting thing. If you're listening and you've never invested in real estate or you've only invested in residential, commercial properties are valued like a business on net operating income. And if you know that and you know how to increase the income and decrease the expenses on a property, you can actually control the value pretty well. And that's exactly what we did in that property. And if you look at the quote unquote IRR, the rate of return for that property, it's probably the best performing project I've ever been a part of.
That's excellent. Our audience, as I mentioned, are they're folks that are 50 years of age and older. They're interested in real estate investing as a means to either help grow their nest egg that they've worked, a lifetime to build up, or maybe they're folks that are realizing they don't have quite the income that they thought they would have going into retirement, and they're looking for ways to create additional cash flow to supplement their retirement, or even to build up a portfolio that they can leave as a legacy to their children. What kind of advice would you have for those folks that are looking at real estate in this way, and as a means to be able to help their particular situation?
Yeah. So first off, I think everyone should look at real estate to be a component of their portfolio. In my book, I talk about how ultra rich families, we're talking about families worth $100 million or more, put somewhere between 20 and 30% typically of their portfolios in income producing real estate. We're not talking about little houses. We're talking about these income producing properties. And the reason is, and this is the reason why the subtitle of my book is called Using the Holy Grail of Real Estate, because you have this increase in return and this decrease in risk. So you need to evaluate a couple things as you look at options out there. One, are you going to be active or passive? So if you're listening, you're 55 or 60, like the investor I talked to the other day, he had a bit of a windfall from a business exit. He had a 7-figure exit, and he was looking for a safe place to put his money that would also give him a good return. Now, again, I'm not saying that all these investments are risk-free. Every investment has risk associated with it. But he was saying, okay, Chris, I have my money in the bank earning 0.5%. Can I do better and get some income in a property that also is going to be an inflation hedge? That's an example of a passive investor. If you say, hey, I want to be a little bit more active, then you have to look at the options that are out there. Don't rush in and buy a property just because somebody said real estate's a good investment. You have to look at what the market's doing. Today in 2021, I believe that property prices are high historically, and it's hard to get rents from a long-term renter that are going to make a profitable project. So you probably want to look at something like doing fix and flips. Hey, if you're on the younger side or you're downsizing, you could buy a project or a property that maybe you pay $200,000 or $300,000 for that house. You can put $50,000 into it, but increase the value 100%. That would be 100% return on your money. That's a cool way to double your money if you are interested in those sorts of things. If not, maybe you could look at something like Airbnb. We just released a podcast and a blog with Kyle Stanley. And if you check that out on the website, I even have a 20% off link in the podcast and the blog that I put up there. And Kyle teaches you how to build an Airbnb portfolio. He actually went out and in 18 months created cash flow in excess of $20,000 a month using an Airbnb strategy. And you can do that with very little money starting out, or you can take a long-term rental and convert it to a short-term rental. And in a lot of cases, double, triple, quadruple your profit margins. So again, if you want to be passive, there's passive investments out there. That's who we cater to. You can click on the invest link on our website and learn more about that. If you want to be active, make sure you understand what the market's doing. That's one of the things we do with our coaching program is we help individuals figure out what the right strategy is for them, put them in contact with the right resources, and really give them the tools and the knowledge to go out and then do it themselves and create true financial independence.
That's great. Well, here you are full-time now, totally focused on real estate. What's sort of your end game looking at your company and where you want it to grow to? What really excites you about your future?
Yeah, well, I appreciate you asking that, Bill. And what's interesting is, what started out as this drive towards financial independence has become a mindset and a philosophy. And what I truly believe now is that if you have financial independence, you can be your best self. So while you may check out our website and say, hey, it looks like they're basically helping people invest in real estate. Really what we are helping people do is, one, educate themselves so that they can understand that financial independence is possible and give them a roadmap for that, and then provide the opportunities. So my mission now is to help as many people achieve financial independence. And I truly believe that if we do that, the world will be a better place.
That's great. Well, we are coming up to sort of the end of the interview here. We have a portion, we call it our Wrap It Up, where I ask you a series of quick questions, kind of like a lightning round. and you share resources that have meant something to you that hopefully our audience can tap into as well. So if you're ready, we can go ahead and wrap it up.
Absolutely. Let's do it.
All right. Favorite real estate book?
So there's a cool book out there called The Secret Life of Real Estate and Banking. And why I like it is because it talks about this kind of 18 to 19 year cycle in real estate. And I've talked about it in a lot of interviews, how you can look back through history and see this cycle. And it's very important to know and understand that cycle if you're going to be successful in real estate long term.
Now you got me going. I want to see that book. Yeah, that's great. How about just a favorite general business book?
Yeah, so this one is kind of maybe a little bit of a twist on business, but Chris Voss wrote a book a few years back called Never Split the Difference, and he talks about kind of some secrets of negotiating. He was an FBI negotiator, and he just has some really great strategies in there. That's
great. Yeah, it is a good book. How about the most valuable website for success other than your own?
Yeah, I'm trying to think of one that I frequent out there. You know, I belong to a group called Strategic Coach, so I rely a lot on that website there. But if it's one that, you know, anybody could have access to, I would talk about like Yahoo Finance. You know, just being knowledgeable about what's going on in the business world and kind of seeing those trends and paying attention to what's going on. You can see history repeat itself and eventually take advantage of those trends. If you're in real estate, I would say the most valuable website would be your city or municipality, because they will tell you where they're going to invest dollars in the future, and that's how you can find the next booming area.
That's great advice. How about a favorite app on your phone?
That'd be my calendar app. I think if you want true freedom, you know, we were talking about financial freedom, but if you want true time freedom, you have to be very disciplined for your time. So I'm staring at my calendar right here on my other screen, and my wife makes fun of me because I have pretty much every minute of every day blocked off, whether it's for my workouts, for my date nights. This evening, it's taken my boys to Taekwondo. But if you put in the most important things, and Craig Ballantyne, who was the first guest on our podcast, which you can check him out, talks about how to structure your perfect day or your perfect week. And the most important thing to do is to put those things in that are the highest priority first thing before you do anything else.
That's great. That's great. Wow. Well, how about a favorite quote that you have?
I always talk about like act as if, and there was this okay movie, I think it was called like Employee of the Month, but in that movie, the main character, the actor's name is I want to say Matt Damon, but it's a different Matt that's out there. So if he's listening to your show, Bill, he's going to be really upset with me, but I don't really care.
It's okay. It's one of his favorite shows. He may be.
Dylan, maybe.
Just kidding.
But he says, you know, basically decide who you want to be and start being that person. And he's talking about it almost like a con artist. But what I would say is if you want to be somebody, picture that person, picture your perfect life 3 years from now, and then start living it. You know, if you want to meet the perfect partner, be the person that you want to be in 3 years and start doing those things. I met my wife in yoga. You know, go to, if yoga, fulfills you and gives you what you're looking for, go do that. You'll probably meet people in there that are looking for the same thing. You know, if you like music, go to concerts. You know, you're probably not going to, meet the person doing something that you really don't want to do, but people tell you you should do. So decide who you want to be and then start being that person.
Great. On the calendar, I forgot to ask, is it a special calendar that you use, or is it just like a Google calendar, or do you have like some special calendars? As I thought of it now, I'm going, wow, it seems to do a little bit more than mine. But
yeah, so I started off, so I kind of figured out my secret using a Franklin Covey planner back in college, because I had to arrange my training time as a cyclist around my class schedules, or vice versa. I would arrange my classes around my training. So I just I'm looking right here at my Apple Calendar on my computer, which is synced up to my Google Calendar. And really, it's not the calendar that's the most important. It is how you use it. And that's why I brought up Craig Ballantyne, because he really talks about how to structure your perfect week.
I like that. Okay. And our final here, and I don't know if this is ever a situation, doesn't sound like the situation you had to deal with, but let's say you lost absolutely everything and all of your assets are gone. All you have is the knowledge that you currently have, okay, and the connections and so forth that you have, and $1,000 in cash. What would you do with that $1,000 to relaunch your real estate business?
Yeah, so I would first off, I'd say I would rather lose the money than the relationships, the reputation, and and the knowledge, certainly, because you can always make that money back. So if you're listening, you're kind of in a bad spot. Just know that with the knowledge that you have is worth a tremendous amount. And what I would do is I would take people out to lunch. So I would go to networking groups and I would find people that were looking for partners in the real estate world. I would take them out to lunch and I would find people that would be appropriate partners going forward.
That's great. Great advice. Well, gosh, I'm sure there's folks that are listening that want to find out more. And as I mentioned, we're going to put your book, a book link in there for you. But how can people reach you and find out more about you, your book, and what your company does?
Yeah, so wherever you are on your investing or real estate journey, we try to have something for you at nextlevelincome.com. We have our podcast, we have our blog, we have our book on there. If you're interested in coaching, you can email coach@nextlevelincome.com if you're interested in working one-on-one with me. And of course, if you have any questions, you can always contact me at chris@nextlevelincome.com.
Awesome. Well, Chris, it has been a blast having you on here. Some real good information. But we have this tradition we have to have to put on you here. Is if you reviewed your questions, you'll see that there's a closing howl at the end of this interview. And I know out in the Carolinas, they've got hound dogs. People go hunting and stuff. So I know how to make that great hound dog howl. So if you're ready, I'm going to go ahead and let you close us out with a hound dog howl. Oh! All right. All right. Excellent. Well, Chris, thanks so much for coming on. We really appreciate it.
Bill, it's been my pleasure. Thanks so much for having me. Love what you're doing for your audience.
Well, thank you. And I also want to thank all our Old Dog listeners out there, too, for joining us. I know there's a lot of other things you could be doing right now, but the fact that you've taken the time to join us means a lot, and we really appreciate it. Please note everything that Chris talked about today, including links to his book and his programs and all the stuff that he's involved with, will be available in our detailed show notes on the Old Dogs website at olddogsreinetwork.com/blog. And you're going to look for the episode featuring Chris Larson. Well, that is the show for today. Remember, cash flow is king and real estate investing the means. Until next time, keep moving forward, and may God bless.
Thank you very much for visiting the Old Dogs REI Network. We would greatly appreciate if you would stop by iTunes and let us know what you think of the show. We would love if you could subscribe to the podcast, give us a 5-star rating, and write a review. The more ratings and reviews we receive, the more visible the podcast will be to others. Thank you.